Today, we're going to try something totally new for both of us. Rather than focus on a specific issue in the world of economics, we're going to tackle a what if question. This was an idea that I had come up with a few weeks ago with Sachin when we were suspended 100 feet above the ground on a ski gondola, and we thought it would be a fun thinking exercise for both of us.
And it was definitely a lot of thinking, Ben. You're probably one of the only people who love to think this deep, but I'm glad that we tried something new here. And to our audience, based on how this episode goes, we'd love to hear your feedback on whether you like this type of format and want us to sprinkle more what ifs in future episodes.
That's right. And to be clear, the idea of this is that we are going to look at what might happen if something in the world of economics changes, and we'll unpack the relevant variables and talk about how the economy might be affected. So, with all that said, today's what if question will be, what if the US switched back to the gold standard? Just as a bit of a backgrounder here, the gold standard is a monetary system where a country's currency is directly linked to a quantity of gold. This was a system that the US had used until the 1970s. And in this episode, we wanted to spend more time outlining the history of the gold standard, understanding why it was used at the time and why we switched away from it. And at that point, we'll pivot back to this what if theme and consider the economic consequences of the US government one day suddenly deciding to switch back to the gold standard. So, with that, Sachin, do you want to start here by walking us through the history of the gold standard in a bit more detail?
Yeah, let's do it. So, as you said, Ben, the gold standard is basically a monetary system where a country's currency is directly linked to a fixed quantity of gold. And with the gold standard, a country's central bank essentially agrees to convert paper money into a certain amount of gold. And so essentially the two physical mediums are interchangeable. The gold standard goes all the way back to ancient civilizations, in fact, but I think it makes sense to start this history back in the 1700s, where Britain was the first country to adopt this monetary system. During the greater part of the 19th century, other major economies, including Germany, the United States, and France, adopted the gold standard as well, and this really became the global norm to facilitate international trade and investment. And I think that the main appeal of the gold standard at the time was that it provided a stable monetary system, which ultimately promoted greater international trade and investment. And it also just created a sense of, yeah, predictability and credibility for countries when facilitating trade. Now, what we had in the US, particularly from 1934 till about 1971, was a pseudo gold standard in the sense that physical gold coins weren't actually used as a medium of exchange. The government continued to issue US dollars as we know them, but each dollar was pegged to a fixed quantity of gold, and it was $35 per 1 ounce of gold from the 1940s onwards.
Sachin, how does the implementation of that actually work?
The key with the gold standard is that the government needs to actually hold physical gold reserves in proportion to the number of dollars in circulation. And a challenge with this is that the amount of gold held must be sufficient to cover the volume of currency issue. In other words, a dollar essentially represents a claim to a certain amount of gold, and this means that the government is responsible for ensuring that anyone holding the currency can go to the central bank and demand gold in exchange for the currency that they have.
Yeah, it seems like this would naturally restrict the amount of dollars in circulation to whatever the amount of gold that the government has in reserve is. And some proponents of the gold standard will say that this could be a good thing because it restricts the unconstrained printing of dollar bills, which could inflate the currency. But I think it's interesting to look at the downfall of the gold standard and think about some of the reasons behind it, because although it's related to that point, things actually went in a bit of a different way. When the Nixon administration came into office in 1969, the world's GDP was $26.2 trillion in 2017 terms, compared to below 5 trillion before 1920, which reflects a really rapid shift toward a new globalized, and economically active post-World War world. In other words, the number of dollars in the world economy had gone up, but the amount of gold in the economy really hadn't been able to keep pace. As a result of that, there were nearly 4 times as many dollars in circulation as there was gold in reserves. And so, interestingly, here, what this implies is that the government was still going ahead and printing dollars just because the economy was expanding, meaning that the gold standard really didn't constrain the supply of money in the way that many proponents of the gold standard think that it ought to. And that was a problem because the country, meaning the United States, simply did not have enough gold reserves to back the amount of dollars in circulation, which meant that it couldn't really convert between the two mediums as it had promised. Of course, no bank today has cash on hand that's equivalent to the value of its deposits, and this to me seems like an analogous situation for the US government. And in that sense, the fact that reserves didn't match the dollar was tolerable. But this also led to another gnawing problem. The fact that the dollar supply increased, but remained pegged to a fixed amount of gold, meant that the dollar had an artificially inflated value with respect to purchasing gold. In other words, this dynamic led to the dollar being overvalued.
So to summarize here, the gold standard was essentially creating imbalances in the system, and it started to have sort of a negative effect on the US.
Exactly. And ultimately, this became very difficult for America's trade in the late 1960s and the early 1970s. An overvalued dollar meant that imports were very cheap for US citizens buying things abroad because the dollar had a lot of purchasing power abroad. But conversely, it meant that American exports were very expensive abroad. And as a result of that, we experienced our first trade deficit during this period in the 1960s that we had since the 19th century. And we were also experiencing employment problems. For the first time, a lot of people in the US started to talk about our economy really significantly losing competitiveness relative to other countries. The Nixon administration was also afraid that other countries were going to start asking for gold and that the US simply wouldn't have it on hand.
That's interesting. And so in 1971, when President Nixon announced the suspension of dollar convertibility into gold, he effectively ended the gold standard. And the US then transitioned to a system of floating exchange rates, which is what we still have today. And since this time, most major economies in the world have also operated under a system of floating exchange rates where currency exchange rates are determined by market forces, just supply and demand. Um, and most currencies now are known as fiat currencies, which I know we've talked about in some of our economics courses. And this essentially is a government issued currency that's not backed by any sort of physical commodity, but instead by the full faith and credit of the governing body that's issuing it.
Now, we're long past the gold standard in this country, but a natural question that Sachin and I asked ourselves after doing all this research is what would happen if the US actually switched back to a gold standard today? And specifically, what would happen if the US made the dollar freely convertible into gold at a fixed ratio, and if there was no restriction on the export or import of gold? So, in other words, a gold standard kind of similar to what we had from the 1930s to the 1970s.
And interestingly, there is a camp of people that argue for the US to actually go back to the gold standard because it provides a natural constraint to the amount of dollars printed, which you mentioned earlier, Ben. And for context here, between 2007 and 2017, the US Federal Reserve printed more money than was printed over the previous 500 years. And this was before efforts to print more money actually accelerated following the outbreak of COVID-19 to address weak economic growth and provide stimulus for that.
Yeah, of course, backing the dollar with something like gold could increase its perceived reliability, but there would be tons of consequences that would flow from the US going back to the gold standard. Obviously, it's impossible to predict these things with precision. International finance is really extremely complicated and at times unpredictable. But the bottom line is that we think that returning to the gold standard probably wouldn't cause a global financial apocalypse, but it would likely be very expensive and inefficient. Milton Friedman, an internationally renowned economist who did a lot of work analyzing the gold standard in the 1960s, estimated that the cost of maintaining a full gold standard could be 2.5% of gross national product, which is equivalent to $600 billion today. And these costs would be so high because gold is not a perfectly elastic commodity. Its production, in other words, is fairly fixed and it doesn't grow at the same rate as the economy does. And this is the exact problem that we saw with the gold standard from the 1940s onwards. That means that the amount of gold in the economy will be chronically less than the total output of the economy. And so, without adjusting the ratio of gold that can be exchanged for dollars, that would more than likely increase the dollar's ability to buy gold, which, as happened in the 1960s and 1970s, would make the dollar artificially strong.
And I'm thinking back now to my international finance courses back at Dartmouth to understand the mechanics of this. But off the top of my head, I think that this kind of transition would have several immediate effects. And I think firstly, it would lead to higher interest rates in the US. If we were on a gold standard, it would mean that the US would need to maintain sufficient gold reserves to actually have currency be converted into gold. But to do that, it would need to actually have gold keep pace with the supply of money in the economy, as you just said. Um, and so as a result, it would need to think of a way to stop both domestic and foreign investors from making large exchanges of dollars to gold and thus deplete its gold reserves. And really, the only way to do that is by having the Fed raise interest rates to make it more costly to borrow dollars, which would effectively encourage people to keep their money deposited in banks and not exchange it. And of course, that's what happened in both Britain and the United States in the late 1920s as they attempted to maintain their gold reserves.
Yeah, that's right. Keeping interest rates high does encourage people to just let their money sit and therefore to not exchange that money for gold and deplete a government's gold reserves. But that kind of a strategy risks really throwing out the baby with the bathwater, so to speak. There would be a lot of cost to the United States and the world economy associated with having interest rates in the United States be higher at a really sustained level. Sachin, you already said this. The cost of borrowing would go up, and that could make it difficult for many commercial entities to secure lending, especially ones that are embarking on riskier enterprises and that can't cope with high short-term interest payments. For example, we saw Silicon Valley Bank, which was making a lot of very risky loans, collapse when the Fed raised interest rates following an increase in inflation in 2021. You could see something similar to that happen to other banks if interest rates remained high for a very long period. It could also cause the US dollar to appreciate substantially, and that would have some important effects. Just to be clear here, an appreciation of the currency refers to when a currency suddenly becomes stronger. And so it's able to purchase more currencies just on its own. And a dollar appreciation here would, for one, make US exports more expensive because dollars would be more expensive, meaning that a foreign country could buy fewer American exports priced in dollars as their currency would simply buy fewer dollars. On the plus side, it would make imports cheaper as $1 could buy more of a foreign currency and thus more imports, which are priced in foreign currencies, than it was able to before. But really, there's a pretty fine balancing act to make sure that trade is attractive in both directions. And just because imports are becoming cheaper, if the dollar becomes overvalued, isn't necessarily a good thing because, of course, exports would become more expensive. Now, an increase in US interest rates could also have some pretty downright jarring effects for the global economy. The dollar is very widely used in foreign trade, and many countries peg their own currencies to the dollar. In other words, they price their own currencies basically along the lines of how the dollar is priced. And so a hike in US interest rates and an appreciation of the dollar could destabilize countries like Ecuador, for example, that are pegged to the US dollar. For example, Argentina had a legendarily catastrophic financial crisis in 2003 that stemmed from its currency, the peso, being pegged to the US dollar. Basically, the value of the US dollar increased in that year, and it caused Argentina's trade and debt position to become totally untenable, and the country's financial system imploded. Things just no longer worked, and the country was thrown into an economic crisis. An overvalued dollar could, however, provide opportunities for export economies like China and Germany that have currencies that aren't really pegged to the US dollar in the same way, and that can therefore take advantage of the fact that their imports would be made cheaper for consumers in the United States. And this is the exact dynamic that occurred when the US was considering abandoning the gold standard in the late 1960s and very early 1970s. It was concerned that it was losing competitiveness to foreign countries who were able to send their exports to the United States very easily due to the high value of the dollar at that time. The final point to note here is that being on a gold standard could limit America's flexibility in responding to an economic crisis. Having convertibility with gold is, of course, reassuring in the sense that it always means that dollars can be converted into a tangible asset, but it's limiting in the sense that just as high interest rates would be needed to maintain a supply of gold for conversion into dollars, it would be very difficult for the United States to lower those interest rates to stimulate the economy in a moment of crisis. And this is one of the reasons that the Great Depression in the United States became so depressing, frankly. The US raised interest rates at the start of the Great Depression to maintain its gold reserves, which in turn contracted the rest of the American economy by encouraging people to keep their money in deposits. And this really exacerbated the severity of the Great Depression.
This all sounds like a hot mess, Ben. At the end of the day, to me, it sounds like there's a reason why we switched away from the gold standard and kept it that way ever since. Um, I understand that many of our audience members may not be economists here, so hopefully we didn't get too technical, but I'm going to just distill this all into one simple sentence. The mechanisms that Ben just described here are the complete opposite of what central banks should be doing to manage growth and inflation in a macroeconomy. And my conclusion in all of this is that by going back to the gold standard, we quite literally would be taking a big step back by moving away from standards that economists all agree on as being best practice. And there's obviously a whole practical challenge of maintaining gold reserves in an economy that keep getting larger. But it also just makes our monetary system far more rigid than it is currently.
I think that sums it up well, Sachin. And of course, I understand where people who support things like the gold standard are coming from, in the sense that it is reassuring to have our currency backed by a tangible asset. But with that said, there is a real risk that pegging the dollar to some value of gold would handcuff our monetary flexibility in the future. And switching over to a gold standard now could really cause a large and potentially very damaging financial jolt. So that's all we have for this week. Next week, we will be discussing the Olympics and not our bets on who will win, but more on the short and long-term economic impacts of a country choosing to host the Olympic Games. So we'll look forward to that discussion and see you then. Thanks for listening to this episode of Toast and Topics. Before signing off, we wanted to disclose that the views expressed in this podcast are not representative of the organizations that we are associated with. If you learned something in this episode, please share it with a friend or leave us a review. Until next time.